Welcome to our latest webinar for corporates. In this series, we'll be examining recent events and looking ahead at what might be in store for financial markets and the economy.
Good morning, everybody. It's September already. Feels like the year has flown by. I certainly feel that way myself, and I'm sure many of you feel the same way. And we've had quite a lot of interesting stuff happening over the course of the past month, which we need to go through. So I'm going to jump straight in there, and we're going to look at one of the biggest changes. Appears to be again a bit like the beginning of this year. Interest rates now look as if they're nearing their peak. And then we'll dive into the rest of the slides. But in terms of interest rates, although this chart doesn't look as if interest rates are nearing their peak, because there's no real sign of a slowing in those rate increases, I think that it's interesting the way in which the language has changed from a lot of the central bank speakers. So, for example, we've heard just overnight from two Federal Reserve members, both saying that they would be happy to support a pause in the rate hiking cycle. I think the other thing to note on the US is, and I've got a slide on this later on, is a material apparent weakening in labour market demand. I think that is going to be absolutely critical in terms of generating the momentum for not only a pause, but actually a signal that rates have peaked, and then the beginnings of rates coming lower in the US. So as much as inflation is important, I think that it's the labour market in the US that will drive a lot of the behaviour in terms of interest rates. As far as the European Central Bank is concerned, they also look as if they're going to pause on their rate hiking cycle, albeit that we had the Dutch central banker, Klaas Knot, who was talking about the fact that he thinks the markets are underpricing the probability of a September hike from the European Central Bank. I don't think that with the benefit of just a couple of hours, he would have been saying the same sort of thing, because we've had some really weak data and survey evidence out over the course of recent weeks, and furthermore, the weakness in the economy was underlined by German factory orders data that was released this morning, which fell by 11.7% on a month-on-month basis, a massive drop in factory orders, and taking us back down to the levels that we were seeing back in sort of February, March time. So very weak numbers that are coming out of the German economy, and I think that will restrict the European Central Bank's desire to raise interest rates any further, even with a few overshoots that we've seen on inflation over the course of the most recent outturn. The Bank of England is probably the only one that's going to raise interest rates further. We think they're going to do another 25 basis points in September. But even there, I think the appetite for them to hike rates further is diminishing, again, because of the weakness of a lot of the survey and economic data, which leads me neatly on to the next slide, which is the manufacturing and services PMIs. You can see here some big slumps in activity, be that the UK, the US, or the Eurozone. I can't see the scale on here. I think I've managed to miss that off. But if we look at these slides, then what you'll actually see is that the blue line is Euroland, the gold line is the UK, and the grey line is the US. And all of them, from a manufacturing perspective, are doing poorly, but actually, probably the most disappointing that we've seen, albeit that we've had some downward revisions to the Euroland numbers. Now, the most disappointing we've seen is the fact that the UK is performing so badly in manufacturing. I think that Euroland may even surpass that in terms of their poor manufacturing performance. But also services PMIs are also now heading below 50, and this demonstrates that in terms of the demand supply dynamic, there's too little demand and too much supply, in my opinion. And perhaps that is further evidenced by the money supply numbers, which we can look on the next slide. That shows that money supply is contracting in all three of those major economies, be that UK M4, Euroland M3, or US M2. And this is the first time I think we've witnessed this ever. So, quite a material worsening in money supply, which again suggests there's too little money and there are too many goods, and that tends to be disinflationary or deflationary. So I think that we may see the risks of deflation continuing to rise, and we've certainly seen that as well in terms of producer price inflation. I think I brought up the producer price inflation numbers last time and showed that producer price deflation was accelerating in a lot of these economies. That trend appears to be continuing. But if we look at what one, I think, very, very key element of the US's interest rate decision-making process, and that's the labor market, this next slide really highlights what's happening. So we saw a trend going into the pandemic from January 18 through to about January 2020, where there was modest but certainly not massive growth in jobs. And then we had the pandemic, obviously huge fall in the labor force, followed by a big rise. So by the time we got to the middle of 2021, like towards the back end of 2021, we recouped all of those lost jobs, and the jobs market was actually bigger in terms of levels of employment than it had been pre-COVID. And that number now stands at more than 4 million additional payrolls. So quite a sizable increase in the number of jobs available in the US. But jobs demand is definitely weakening. And when we look at data such as the JOLTS job openings data, that's now back down to levels that we saw 2 years ago, and probably liable to fall further if we look at things like businesses' desire to invest. I don't think that it's there either. So whether we're talking about capital investment or labor investment, I don't think that the jobs market is as plentiful because of the fact that businesses just don't think they've got the capacity. And a lot of that is down to higher interest rates. So the higher interest rates are having their effect, but the US jobs market and labor markets generally tend to be very slow to react. But they're definitely showing signs of slowdown now. We saw a rise in the unemployment rate. We've seen a rise in underemployment in the latest month's data. And we've also seen that average earnings growth is starting to slow in the US. And given that it's the US economy that's done the best out of all of these major economies in terms of weathering the pandemic storm, then I think there are increasing signs that we are very, very close to the peak in interest rates, or perhaps even at them already. So then if we move on to the next slide, that begs the question, well, which way will markets break? Because over the course of much of this year, really since the end of the first quarter, we've had the financial markets and the FX markets in particular not really doing that much as far as moving higher or lower. That uptrend that we saw in sterling dollar does appear to be breaking a little bit. We've tried lower. That downtrend that we saw in euro dollar seems to be being reinforced after the rise that we saw to multi-year highs in euro dollar. Sterling euro is probably the most boring of all of the currencies, but even there, its efforts to test higher, I think, are being thwarted. And so downside risks, I think, are opening up. And whilst the official forecast that we put out might be suggesting that there's potential for more constructive behavior in sterling dollar and euro dollar, so dollar weakness, given the fact that the dollar index is close to a 6-month high, I think the risks are that we could see some setbacks in the final quarter of this year in terms of sterling and the euro against the dollar, in order to try and generate some value in these currencies. We've seen a huge rise in sterling dollar since its lows of September 2022. I think it's risen by more than 20%. I think it's similar in terms of euro dollar, in terms of the gains that we've seen there as well. So the big rises that we've seen, I think, are done and dusted. And the potential is now that markets may break lower in order to test those downside levels and try and create some value for both sterling and the euro. So if we look at the forecasts, and one thing I wanted to draw your attention to on this slide is that we are still making adjustments to a lot of these forecasts, but the risks on emerging markets do seem to be increasing in terms of additional dollar weakness. So we could see more weakness in terms of the South African rand. We could see weakness renew in a lot of Asian emerging currencies. I still think that we might be wrong in terms of our forecast for dollar China, and it really depends on how aggressive the Japanese authorities become on the yen, because the weakness of the yen, which is trading at around about 147 again, is one of the things that I think is creating an undercurrent of weakness in the Chinese currency alongside all of their economic weakness. So they don't want their currency to be out of kilter with what other Asian currencies are doing, and so they're allowing it to trade more weakly, purely because they're trying to bolster export markets. But exports are going to be more difficult to come by, and growth in export markets is going to be more difficult to come by, purely on the basis of the ongoing weakness that we're seeing in the global economy. And it's interesting that only a month or two ago, we had those upgrades to the forecasts from the likes of the International Monetary Fund and the Office for Economic Cooperation and Development. Even the Bank of England and the European Central Bank and the Federal Reserve got more optimistic. And yet ever since that point, all of the global economic statistics have pointed to a weakening in economic conditions rather than a strengthening. So I think there may be some downgrades coming when we get the October changes to the IMF forecasts, and when we get the November forecast update from the Bank of England and the forecast updates from the likes of the European Commission and also the European Central Bank. I'd expect to see growth forecasts weakening into the end of 2023 and throughout 2024. What does that mean for FX markets? I think in a weaker global economic environment, that lends support to the US dollar, not from a flight to quality perspective, but just for, you want a return of your money rather than a return on your money. And so you're going to place your money in the largest, most liquid markets in the world, and to a greater extent, and that's more likely to favor the US dollar. So that's my bit done. Hopefully that has been informative and interesting, and I'll hand you over to Piers now. Piers, I'm sure you've got plenty to talk about as well, as we're coming to the end of the third quarter, so I look forward to hearing what you have to say.
Yeah, I like to see you using some charts there now, Neil. That's very good to see. Yeah, very interesting presentation by you as ever, and now we'll look at it from the chart point of view. So this is the way the charts look on the monthly, and as Neil just said, the important ones really are the beginning of next month, because we'll get the end of this quarter, it'll be the end of the third quarter, and it will set us up for the range into the end of the year probably. So on the first chart we look at, this is the dollar index. So the dollar index, we can see that bounce happened off the support zone we had down there, sort of 101. Last month on the webinar, I said, well, price holds above 101.30, look for a test higher towards 103, 104 area. And to see sustained dollar strength, I said price really needed to return above the 105.50, 106.50 area. And potentially as we near that area, we should see some sort of change in risk reward. And I think that's what's happening now. We are getting towards that 105.50, 106.50 area. We've done that move up to the 103, 104 resistance. But I think maybe you might just get a slight change in risk reward. It's always very difficult because the trend's very strong at the moment. On the daily charts, weekly charts, strong downtrend. Try and say, look, this is where I think it stops. It's a bit like, that thing where you try and catch knives or something, some people say. But I do think as it gets to 105.50, 106.50, the dollar might just start to struggle a bit. We might see that change in risk reward. Support, though, now, the pullback should be about sort of 102.90, 103 area. And only below 101.60 have the dollar bulls had a bad month. So it'll be an important month, as I say, leads us into the close of the third quarter. Maybe a sort of pull back for the first couple of weeks off the 105.50, 106.50, and then maybe find some support and have a move back up. So that's the dollar index. Let's look at actual currencies now. This is euro dollar. Excuse me. Asthma comes back. It's that seasonal asthma time of year. So it's just worth pointing out some of the things. And one of the things I pointed out in July, the beginning of July, I said, after looking at the quarterly chart, I said price suggests a jumpy July and a strong directional August. And that's really what we saw play out as July saw price rally for the first 2 weeks and then just collapse back down to the same sort of area over the next 2 weeks. But then August, you got that nice directional move. And I think it's just worth pointing out because these things I only get to talk about on the webinars. So at least you get some sort of heads up on this. I don't really put this all on my weekly charts. It's not sort of the right sort of format, but here we can talk about it. So if we go to the next slide now, where's that move down, that directional move from August taken us? It's taken us down towards that 106.30, the 20-period moving average on the Bollinger Bands. So I think as you near there, as I say, with the dollar index getting up towards the 105.50, 106.50 area, I think as euro dollar gets towards that 106.30 area, maybe the risk reward changes slightly. You know, if we look at the next slide, can we go back to the last slide? Because there's one other thing I was going to say. One thing I pointed here was that big arrow when it happened 2 months ago. You hit the old trend line and fell off. So this is a good fall off the old trend line. So now, since the end of 2022, price was in an uptrend. It retested the old trend line, is now coming off. So it's going to be very crucial where it finds support in this pullback because that was the big move up and now it needs to find support on the pullbacks. Otherwise, it would just be a break, retest, fail and lower levels. So we need to watch this carefully on the downside. So now if we go to the next slide, sorry about that. So where do I see resistance at the moment? Well, if we look at this was the extension swings we were following up on these webinars, and it never closed above that 38.2%, which is 110.95. So at the moment, I have initial resistance, I think could be for euro dollar this month in the 108.60, 80 area. But the strong resistance is that 110, 111 area. You need to see price back above that if you want euro dollar to do a significant move higher rather than just a pullback. Support should be, as I was saying, at that 105.95, 106.30 area from that 20-period moving average. So let's just see how that support holds out. If euro dollar doesn't rally and we close the month below that 106 sort of 106.30 area, then I think that would be negative longer term. But that's something we can cover on next month quarterly chart if it happens. So we go to the next slide. The next slide we've got here, sterling index. So since that morning's in the blue circle, I have the Morningstar candle formation, reversal candle formation. We put on these charts last year. And with that spike, we said, will this spike save sterling? It certainly has. We've seen prices rally now to higher since any stage since the Brexit collapse. So the other thing on this slide is the Bollinger Bands are slightly widening out. So they narrowed and now they're slightly widening out as price goes up. So that should be supportive for sterling overall. And last month I said as long as pullbacks low are held by the support in the 61, 63 area, then there's potential for dips lower to attract buying for a longer term test towards the 61.8% area around 68.75. And that remains the case here. Where will we start to question that view? Where does sterling start to seem to run out of favour with everyone? I think below 63.5 in a monthly close will be the first blow. And then if you got below 61, suddenly something's gone wrong with sterling strength. And we'd have to sort of look into that when it happened, why it happened. So we'll look at the quarterly chart is the real key one here because we on sterling index. So we'll look at that next month. And now we've moved on to the sterling dollar chart. So this sterling dollar quarterly chart The thing I like here is that 128 area. Last month I highlighted that 20 period moving average and said that price had slipped back below it. And it's only 2 months till the quarterly close. Now, I said to keep an eye on that 28.12 area, and it's stayed below it and gone lower. So if you want sterling dollar higher and you're sitting there going, what signal can I get that sterling dollar is going higher and this move lower is sort of stalling, you want to see it close the quarter, so the end of this month, back above that 128.12 area. Because below that, with the large spike on it, is a fail at that line, which is negative. So if we look at the next chart now, we can look at the monthly chart. So on the monthly chart, we saw it break above the 20 period moving average, the pink line in between those Bollinger Bands, which was 23.5 area, and price rallied, but it got capped by the top of the Ichimoku cloud. And I said, watch the fall lower, and we need to see if there's any buying interest as this nears 124, 25, 45 area. And that stays the case now. Look at that line. We are moving down towards that line. This is what we're saying. We had a spike down towards it last month, but it rallied back up to close above it. Again, this month, we're having another push lower down towards it. So that's a key area of support. So what do we know now? We know where the resistance is, the 128. What do we know where the support is? 124.25. So you just want to watch those sort of areas. Everything in between is a bit of noise on these longer term charts. And then we go to the last chart, last cable chart. This I find has been very useful, this extension swing. So we took the initial rally, did the pullback, and then extended it up with the extension swings. And if you look at those blue circles, it's captured every rise and fall of sterling dollar. And last month, I was talking about the 38.2, and you can see that it went back down to that level last month, rallied back up off it, and closed above it. But this month, already in the first few days, price is pushing down below it. So we need to watch that as the month goes on, because you had that orange downtrend line. So we had a break above the downtrend line, and it went up to 61.8%. Prices pulled back down, stopped last month at 38.2. It might go down, but where's that key area of support? It's where that 23.6% comes in, because it's also the trend line. So that's going to be very important. So initial support this month should be the 124.80, 125.20 area. If that's broken, goes down to that 24.25 area. Now, if those break, then you can see a move right back down to 123. But what we have to see is, we were looking at euro dollar just now, dollar index. All those are suggesting maybe we're getting near an area where the market turns. And I always like the market to turn more when people aren't ready for it. Because when people are ready for a turn, everyone's building up, look, there's going to be an interest rate, they're going to say this, they're going to do that. Markets are ready for a turn. I always think it's a bit nicer when a market turns just because the buyers come in because they want to. So that's what I'm gauging here. Are the buyers going to come in? Are they going to think this is an opportunity and buy? Because if they don't, then sterling dollar's in a bit of trouble. But if it can find those buyers off those support areas, we need to see it get above 126.80 to take away the downward pressure to start with. And then 127.60 becomes the next area of resistance. But the key is that 128.12 from the quarterly chart. You really want to be above that if you want to be positive sterling dollar. So that's on sterling dollar. The next chart is euro sterling. Now, Neil assures me that more people who watch this want to know sterling euro than euro sterling. So in the slide pack we send out, I'll put the euro sterling levels and my thoughts. But what we're actually going to do is go straight to the next slide, which is just sterling euro the other way around. But if he's wrong on that, let me know. If you'd like to see the the euro sterling version, I'm always open to change. So last month, I highlighted we had the first monthly close above the 20 period moving average from the Bollinger Bands. And that was the first close in over a year. So I said I saw support was going to be in the 115.20 area with stronger support in the 114.60 area. And only a clear monthly close below 114.60 would take away the positive feel from the break. Now, the low on the system last month was just above that 115.20. So that support held well. Resistance, I said, was going to be around 116.75, above which on the monthly chart, I said 117.65 area opens, with potential maybe for 118.35. And last month, we saw price go up to and trade slightly above that 117.65 before falling back down to close. But where's it closed? So it's got above the 20-period moving average. And how do you use these things? You know, we send you these charts. What should you be looking? What use are they? The use they are is look at that 38.2%. How many times do I talk about the 38.2%? Where did the market close? The month before, it closed on the 38.2% after rallying. Last month, it opened and closed on the 38.2%. So if you want sterling euro higher and start to rally higher, you need to see it break away from that 38.2% higher and price in a higher close. So that would be positive. If it gets back below that 20-period moving average, then that's a bit of a shame because it's had the opportunity to perform and it hasn't performed. So this month, I've looked for support initially around 116, sort of 116 figure 20 maybe. And below that, you might see back down towards that 115.20 we mentioned last month. As before, only a monthly close below 114.60 would be worthy of note. Resistance this month, I'd expect that in the 117.65-95 area with 118.55 if it got above that. But that sort of 118.55 area, that should be a good maybe cap this month if it does rally. If it gets above that, that's very good news for sterling.
Thanks very much for listening to the webinar. We hope you found it informative. The next in the series will be available shortly.